Hey, welcome to the Closing Beat, everybody. Happy Monday. How you doing out there? Good? I'm doing good. Got a new pair of shoes. You get a new pair of shoes, you feel better. You feel better, you do a better show, right? So here we go. This is a quick show that we do called The Closing Beat. We'll go over the stock market, all the good stuff there. Hope you'll check us out at Jazz Wealth Managers. You go to jazzwealth.com, you can check that out. Also, if you're interested, no hard sales pitch here, jazzwealth.com/research. You can go and see what's coming. That's a golf club. There we go. You can actually see a little snippet of what the research program we're going to have, membership site for people that can't join us as customers but still want to participate in some of the cool stuff that we offer, a little more education and knowledge and things. So I hope you'll check that out. And I'll show you some of the stuff that we're going to share on the site here in just a little bit. Let's take a look at the stock markets here today. You got a decent gain across the board. You wouldn't have known that if you looked at the markets earlier in the morning. No decent gain. You look at the markets middle of the day, all right, recovery, right? Get about zero, excuse me. You got about flat line for a lot of the sectors there. And then right towards the middle of the afternoon-ish there, you got all of a sudden a pop, and then the markets continued into positive territory for the day. Completely opposite of Friday, where we had a sell into the rally mentality throughout the day. I showed you on Friday on our show, every time we popped, it would just get sold into. Today, we got a dip in the morning, and everybody just hopped on that to buy. So what does that tell you? Anything, right? If you have one day that's looking really strong, week, and the next day is looking really strong, what's that tell you? Well, if you look at the S&P 500 here, it tells you that there's a lot of indecision in the markets. We're coming off a big sell-off there, a big pullback that a lot of people were waiting for. We had a day of weakness, a day of strength. You need more information. That's basically what that's telling you there. The reason for the pop here, and I'm going to share this with you, I'll go 5-minute chart. Here is the 2 o'clock time period. Right at about 2 o'clock, the Fed came out and said, you know what, we're going to start buying individual corporate bonds, and the markets love that. The Fed doesn't do that. So the fact that they're going to do that, they maintain that this is still a big issue out there, the virus and the economic slowdown because of it. And so they said that markets started to pop. Doesn't matter where you look. You look at the NASDAQ, you got the same 2 p.m. pop. You look at the Dow no, that's not the right one there. Dow, there you go. So the Dow popping up there, you got the same pop going on, all looking good there. The Russell 2000 was the strongest of the group on the day. If you take a look at the Russell, it also got that same 2 p.m. pop. Let's go back here though. We're going to go to the daily chart. The Russell coming down to the 50-day moving average. It was the strongest year-to-date. Healthcare, there was a snapback in healthcare. We're going to talk about that a little bit more here as we go through the healthcare sector there. And technology was also strong in the area there as well. If you're going to take a look at some of the biggest contributors to the gains in the Russell, if we look back over the last month, restoration hardware, no doubt, very strong, amazing decline and recovery in restoration hardware. That one is the biggest contributor to the Russell 2000's gains over the last month. You also have Penn National with all the excitement there. Today had a 6.5% day after this recent pullback. That is the second biggest contributor. And then Decker's Outdoors is the third biggest contributor. Those three stocks have the biggest contribution to the Russell 2000's gains. Anyways, moving on, look at the Dow here. You've got the Dow up over 1% on the day over the last month. The Dow really was sort of held back today because of a couple names first. Let's do this here. We'll go over to Chevron. Although it closed off of its lows today, you can see by the green candle there, still down 1.26% on the day. And then you had Merck down 3% on the day, very extended healthcare name, and you had Home Depot really unable to get back to positive while the other markets did. Those three relatively weak names compared to the Dow, and that you have a recipe for the Dow being a little bit lower. And so there you go. I just want to share that with you. Over the last month, your biggest draggers on the Dow are going to be healthcare related. So there's going to be a theme to today's show is going to be healthcare. You got Johnson & Johnson down 0.63% today, but one of the draggers on the Dow. Merck and you can see how extended that is there, just crazy. And then you got United Healthcare, one of the draggers there as well. Those are the three biggest drags. Now, funny that they're in that category, huh? That's kind of interesting. Maybe there's some opportunity there. At least you've got to ask that question. All right, let's give you a little bit of a study here, and then we'll take a look. So in our research by Jazz that we're coming up with here, that we're going to be launching, jazzwealth.com/research. That's all you got to type in there. The type of things we're going to focus on is what the markets are doing currently, but I always want to teach. I don't want to just be one of those people that says, this stock looks good. I want to explain why, and I want to go over the stats and the data behind it and everything, or the markets look strong or weak, and here's specifically why, rather than say, you know, the other places where you could just get stock recommendations. I want you to learn. So it's really educational based, and you guys know that about me by this point here. Let's take a look here. Here's what we had last week. The put-call ratio, if you're familiar with this, very popular metric tracked in a number of different ways, whether it's on the S&P or CBOE, however you want to track it. Well, if we look at the S&P put-call ratio, basically all this means is it's a ratio between the number of puts bought versus the number of calls bought. And basically, the lower the line here on the bottom, this is the S&P up here at the top, this is put-call ratio. The lower the number, the more calls that are being bought relative to puts. So, for example, when the markets were moving higher, there were more calls being bought than puts. People were bullish. They were excited. Over the last week, and last week in particular, you had a rather sharp increase in that number, meaning people were going more towards puts, being more protective about their position, using hedges, whatever they were doing. So we had a sharp increase. Looking at this is one thing, but the strength of the move is what we're focused on. Last week was actually almost a record week. And what happened is basically we had the biggest move from 1 to 2 that we've seen in a while. We just don't have that, right? We have sharp moves that are along the way where you have quick moves towards hedges or protection, but going from a really bullish position to a really bearish position so quickly over the course of a week is actually quite rare. So what we did is we took a look back and we looked at the performance of the markets every time that's happened to see, should we expect the markets to be really bearish? Should we expect them to be about average? Or should we expect them to be very bullish going forward after such a sharp increase in the number of people that want to buy puts? Now, this may sound kind of funny here, not the blower that's going by real quick. We're getting the whole place is getting a lawn mowed today because it's been raining. But this may sound funny, but the stock market actually isn't bearish when the put-call ratio spikes the way it did. Let's take a look. I'll just show you here. What we did is we took a look at the put-call ratio having such a sharp move from 1 to 2. All we asked for it to do is be at least 75 basis points from 1 on the way up. So all I had to do was make it from 1 to 1.75 to make our criteria here to include in our scan. We're looking for such a sharp move as that in a 5-day window, so we could say over a week's time period, this is what happened. What you're seeing here is a black and blue bar chart. The black is the market's performance following such a sharp move in the put-call ratio, and the blue is just the market's average. So you may know this already, but the average daily move for the S&P 500, looking back over the last 20 years, is 0.03% positive. So it's very small, but if you had to bet each day if the stock market was going to be higher or lower, you lean just a little bit positive there. So anyways, as you can see, the next day following a 5-day stretch of a sharp move in the put-call ratio, it's basically on par. It's flat. Over the next week, it's basically flat. Over the next month, they're basically comparable to the long-term average, meaning comparing only that window of time where the put-call ratio spikes versus every other time on the planet, right? There's really not much of a difference. There's not a horrible amount of difference, half a point here in the 3-month average. You get a little bit of a spread over the 6-month, but basically when the put-call ratio spikes as sharply as it did, it leads to inline market performance, right? You just don't see anything out of the norm there. So a lot of people would think, and the lesson here is, you look at something like that or you see it on TV and they go, oh my God, the put-call ratio spiked. But the lesson is it really doesn't lead to anything. It doesn't do anything out of the abnormal there. So anyways, on our website, thejazzwealth.com/research, if you're interested, you cannot be a customer for whatever reason, or you enjoy managing your own portfolios, that's the type of stuff we'll expand on through posts and videos as well. If you'd like, you can leave your email and we'll just email you when it's ready and it's up, maybe 2 weeks to go. We will not keep your email. We won't spam you or anything, but I hope you'll check that out. Anyways, let's go to our sector breakdown here real quick. We'll just take a look. There's just kind of a Monday recovery type day here. So I will go through a few things. Last week, all sectors were down on the week. Energy was the worst with 13%. Tech was the best, only losing 3%. And today, recovering one of those 3%. So every sector started the day with a decline and then bounced from there. You're going to see that in the following charts here. Communication services was the best performer overall. 1.6% gain on the day. Bounced back into positive very quickly. Names inside that sector. EA almost hitting a new 52-week high. Viacom in there as well. Not hitting a 52-week high, but having a strong day. 8.6% day. And then ATVI, Activision Blizzard, strong day as well, 2%. You got to look at Facebook anytime you look at communication services because that makes up 20% of the sector. That was up on the day, just about 2% overall. Energy was one of the bigger movers on the day. It doesn't look like it, but it started off as the weakest. It did finish close to being the weakest on the day. It had the biggest range, and you're just going to see some action here in Chevron. We talked about that one just a minute ago, and energy related type stuff was all off of their lows. By that, I mean OIH went back to a positive gain of 0.5%, and XOP was negative most of the day and actually get a gain of about 1% on the day. So that's that one. Healthcare. I'm going to hover on healthcare here for a second. You've got the sector up 1/4 point on the day. Very extended drop to the downside there. Fell back to the 200-day moving average. You're getting a lot of interest in this area today. I thought this stuck out as one of the sectors that grabbed the most bullish interest, although it wasn't like it, had a rock star day. Just grabbed a lot of interest there, right? Dexcom gets a lot of attention. That one really woke up today, up 7%, hitting highs for the week. Really just nice and strong there. And now, of course, part of the S&P 500. You've got Merck extended to the downside. Already mentioned that. Down 3% on the day, adding to its declines there. Overextended, down over 10% in 5 days. You got Bristol Myers also extended to the downside and saw some buying today. Take a look. You saw this push to the downside, and look, you got a little tail after a multiple day decline, down over 12% in the last 7 days. You saw people say, that's enough. That's the bulls put their foot down and said, we're going to take it from here. I'll cover more of this in here in just a second. Real estate, sharp move on the day, up 1.25%. Also, I'll point out the home builders did well today, but in the REIT sector, you've got Realty Income, ticker symbol O, very popular with you guys out there, 3.5% gain on the day. And then you have Alexandria Real Estate, probably one of the better looking charts out of the group, almost 4% gain on the day. This is like a science and research center type REIT if you're interested in that sort of thing. I thought that stood out. Home builders, 3.25%, very nice reversal off the 200-day moving average. And it was actually the home builders that had the good day, 7% for Lennar Homes, Dr. Horton up 3.5%, and then Pulte Homes strong as well, 5%, not quite over the 50-day moving average. We'll take a quick look here at the price of oil, up 1.9% to $36.94 a barrel, kind of softening out its most recent pullback there. Not a whole lot else going on there. You got gold inside this range here, tightening up. That's a good sign. You got a wide whippy range here to start, and all of a sudden it's starting to tighten up. Less volume. It's starting to really tighten up at this uptrend here, so that's pretty cool. And that's pretty much all I have for the sector breakdown. Our technical breakdown is going to be rather quick here. It's going to be rather quick because there were 0 new highs. Adobe was the last stock to make a new high, and that was on Friday. And there were 0 new lows. You got 5 weeks, just over 5 weeks now, that no stock in the S&P 500 has made a new 52-week low there. Technical patterns today. I've been sort of highlighting some of these with you. There have been a lot of good ones lately. I want to focus more on healthcare. I said it. United Healthcare. Here you go. United Healthcare down over 10% in the last 5 days, started to recover. You got to recognize stocks that have quick drops in a short amount of time. When that happens, they tend to bounce in a short amount of time. So quick drops lead to quick rallies. So for you shorter term traders, you scalpers out there, these are the kind of things that excite you. Merck, you already know, that's going to be about the same there. Cigna down over 13% here from those highs, right at the 200-day moving average, started attracting attention today, volume increasing. It tells you that it doesn't matter what I think if the stock will bounce or not. It tells you that traders think the stock is going to bounce. That's the sort of watching, as they used to say, watching an elephant put his foot into the bathtub full of water. If I get in a bathtub, all right, the water level rises a little bit. If an elephant puts his foot into the bathtub, water level is going to overflow, right? That's your sort of analogy to take a look at some of these stocks. Cigna, of course, off the 200-day, and we talked about that. Bristol Myers, very extended here to the downside, getting towards a Fibonacci area for you people that like that. Obviously, Bristol Myers down over 10% in the last couple days there. It seemed like the bulls were walking into the healthcare area today. I can't tell you what to do. I can only point out things that I noticed there. What we'll do tomorrow is we'll go through relative strength and weakness in this sector. That'll be our sort of study of the day. The typical thing we'll kind of post on our research page, jazzwealth.com/research. And if you want to go to the bottom, you can leave your email. We'll let you know when it's ready, but you can learn all about it there. Did I say that yet? Anyways, we'll go through relative strength and weakness on these healthcare stocks. So if you say, I want to buy the strongest stock in the group, even though it's pulled back, or I want to buy the weakest stock, I'll kind of go through that and show you how to take a look at things like that. All right, let's go to stocks in the news. There's not a whole lot to go on here. We're coming up through the quiet part of earnings season and everything, but I'll start with Target. Target raised their dividend again. You probably already know this. I think they did it on Friday. That's going to be 49 straight years that they've raised their dividend. So if you like your dividend payments there, you gotta see if that's something that's right for you. But 49 straight years of raising their dividends. Good job, Target. Hertz, you want to see something interesting here? I've had more questions about Hertz than ever from all of you stay-at-home traders that have nowhere to go. And it's not your fault, but you have nowhere to go, and so you're trading. More people have said, do you think it's worth a shot? Should I just take a shot? Well, now it's not up to me, because Hertz themselves said, we're going to issue, they got approval to issue $1 billion worth of common stock shares. So if you've ever been in the financial industry or been a broker, whatever you've been, you had to take a test. And on that test, you were taught that if a public company applies for bankruptcy, Chapter 11 bankruptcy, and they go through the process, well, who gets paid first and how do they get paid, right? You had to know this answer. It was a question that was asked on the test. And so first it starts with secured debt. Then it goes unsecured debt. Then it goes preferred stock. And all the way at the bottom, after some other little miscellaneous things, you've got common stock. You're the last to get paid. Now, Hertz is going to issue first $500 million in common stock. Hertz themselves, because of the bankruptcy, had to put on their filing, and they volunteered to do this. They weren't required to do this. They had to put on their filing that they fully expect the shares that they issue to be worthless to the common stockholder. So it's no longer my opinion whether you should buy Hertz. Hertz themselves has said, we ran the numbers. By the time we pay secured debt, unsecured debt, miscellaneous, preferred stock, we'll get down to the common stock, it will be worthless. They said that, not me. So when you think about buying shares of Hertz, why would those shares be worthless and these shares not be worthless that you could buy today? Be very careful with Hertz. They're playing some games there. I applaud them on the games. I can't say I wouldn't play the same game, but they're playing games there. So careful. All right, couple last things here. You got H&R Block reporting earnings tomorrow. Yes, tomorrow after the close, expecting $2.61 a share. This one's tough. If you look back at the performance of H&R Block, when it gaps higher, it doesn't gap higher a lot, meaning when it reports earnings that people seem to like, it doesn't blast off and just take off and you have this amazing run. When it reports earnings that people don't like, it tends to have nasty declines there. So just be careful with that one. Average quarter two gap, which is they're going to report quarter two earnings, is 0.34% to the downside, although that's an average over the last 12, 13 years, somewhere in there. Last 74 quarters is what I looked at. So careful, because when it gaps down, it tends to be nasty on that one. If you own it, you're ready for a little volatility. Oracle's also going to report here. They have not missed on earnings in the last 15 straight quarters. They're going to report second quarter earnings. They beat on second quarter earnings 78% of the time, revenue 83% of the time. So, and this one's a mover. Don't be alarmed if you see a big move here for Oracle. It can get up and go. So that's that one. We talked about Hertz there, right? Last thing I'll share with you here is you've got some shuffling going on in the S&P. All my index fund people out there, you've got some adjustments to make. DocuSign is going to replace United Airlines in the NASDAQ 100. So that's an adjustment there if you have any NASDAQ 100 adjustments you need to make. I don't know. I'm just pointing it out here. That'll happen later in the week. You got Bio-Rad. They're going to be replacing Harley-Davidson in the S&P. Harley-Davidson. You got Teledyne replacing Nordstrom. So Teledyne's going to replace Nordstrom in the S&P 500. That starts later this week as well. And Tyler Technologies is going to replace Alliance Data, which hasn't had a good run lately. It's going to replace the S&P at the end of the week as well. Got a lot of adjustments going. No, beginning of next week. I'm sorry. All of that happens the beginning of next week. Those were just announced today. So you've got some adjustments to make there if you are index fund investor person. So that's pretty much all I have. I hope I helped you in some way today. I'm going to keep sharing some of the data, research, and things with you. If you'd like, you could check out jazzwealth.com and join us with your Roth IRAs. Hope you'll consider transferring your account. And now, if you cannot join us, and you still want to participate in the education, research, and our notes from Jazz, go to jazzwealth.com/research, and you can kind of see what we're offering there. If it's something that interests you, of course, well, we'll let you know when it comes live. Just leave us your email, and we'll let you know. That's pretty much all I have here for you today. I will wrap it up, and hope you have a great rest of your day. See you later.